All right, so in this video, I'm going to talk a little bit about the importance of the Federal Reserve System and kind of what it does a little bit and so forth. So the Federal Reserve actually has an interesting mandate to accomplish several things. So the primary function is to essentially control the supply of money and credit, and thereby to regulate the cost of credit, in other words, the interest rate, specifically more short term, in a manner that will affect aggregate demand in a direction that will contribute to the achievement of full employment, stable prices, rapid economic growth, and balance of payments equilibrium. And if you're looking at that list and thinking, wow, that's a lot, it is. That's a lot. And whether that all goes together is quite a whole other story. So basically, let's kind of break this down a little bit. So what they're trying to do is they're trying to control the supply of money and credit, and therefore can regulate the cost of credit, in other words, the interest rate. So they're affecting the money supply to change the interest rate. And the Federal Reserve has a lot more impact on the interest rate short term than they do long term. Long term is going to be a lot more driven by economic fundamentals of the economy as a whole, and sort of the country's financial situation and governmental situation, et cetera, as a whole. So the Federal Reserve is going to have a lot more influence over short term rates. And they're going to be trying to do that to achieve these other objectives, right? And so let's kind of break down those objectives a little bit. Full employment. That full employment in this context doesn't actually mean that everybody has a job, because we would normally expect that somebody is not going to have a job sort of normally. And let's kind of talk about why that's the case. Let's say you get unhappy with your job and you decide, you know what, that's it, I'm done. And so you hand in a resignation letter, you tell your boss, I quit, whatever. I give you 2 weeks notice. Well, so if you do that, then you're going to be very quite possibly, at least temporarily, unemployed. But that was by choice. And the thought would be that if you're looking for a job at some point, and hopefully not too distant future, you find another job. So the idea behind the full employment would basically be that if you are looking for a job and want to have a job, that you can find a job and get the job. So that's kind of what we're looking for. That doesn't mean that nobody is out of a job, because I'm going to have people that are out of jobs. They quit. They're in that process of getting another job, or maybe they needed to move across the country, so they quit one job. They're moving halfway across the country, and they're going to look for another job. And during that period, they don't have a job because they're moving. And so basically, full employment basically says, well, that's normal. That we're not worried about that because all that's normal. What it means for full employment is basically the people who are looking for jobs, trying to find jobs, are getting jobs. That's the idea. So I would still have sort of normal transitory unemployment where somebody's switching jobs. They technically are unemployed during the gap in between. That's not something they're concerned about. But if they have a whole bunch of people who are actively looking for jobs and they aren't finding them, they aren't able to get employed, and they're just persistently unemployed even though they're trying to get a job, that it would be what the Federal Reserve would be concerned about. And that would be the unemployment component that the Federal Reserve would be focused on. Stable prices. So basically, for stable prices, they're going to be looking at making sure we don't have inappropriate levels of inflation. So what they want is nice, stable, predictable, consistent inflation. That's kind of what they're looking for. So let's define a few terms. So inflation. Inflation can be defined as too much money chasing too few goods, which basically means price levels generally go up. So if the price of one thing, eggs, for instance, if the price of eggs goes up, but other things aren't generally going up, then that's not normally what they would consider inflation, because it's just one thing. But if the prices of everything broadly in the economy as a whole on average are going up, that's more the inflation. Because I could have, some kind of bird flu that breaks out that basically wipes out a whole bunch of the chickens that are laying eggs, and that could be a weird fluke that causes basically egg prices to go up, but it may not really relate to the broader economy in terms of it's not some systematic economic thing that's going on that's causing this. This is something unique to chickens, basically. So if you had something that was happening to one specific thing, that's generally not considered to be more of inflation. Inflation is more like the broad price level overall. So if you look at a basket of goods that a household normally buys, or services, and you're looking at all of it overall. So not just food, but if you think about, bread, milk, eggs, your mortgage payment, what it costs to buy a TV or a cell phone or a computer, all these kinds of things, medical care, education. You start looking at all those kinds of things and you try to come up with an aggregate price for a grouping of all of it. If that aggregate price is essentially rising a bunch, then that would be inflation, right? Now, if we have just a little bit of increase, that's a little bit of inflation too. But the Federal Reserve is not going to worry about a little bit of inflation. If it's low, stable, relatively predictable, it's not too much of a problem. The reason why it's not too much of a problem is if everybody expects everything to go up in price by 2% next year, we can plan for it, right? That means I'm going to kind of hope and expect that my boss is going to give me at least a 2% raise to keep up with inflation. I'm also just going to kind of expect, all right, all my stuff's going to cost 2% more. So basically, I can kind of plan for this. Businesses can make similar plans and so forth. What's going to be a problem is if we thought there was going to be 2% inflation and we get 15%. And all of a sudden, everything's costing wildly more than was expected. That's going to be a problem because businesses were making all kinds of investment choices and decisions based on what they thought was going to happen. And then that wound up being wildly wrong. And now it becomes a big mess to try to figure out, well, if I'm a business, what do I need to charge for these products to actually make money on this when all my raw materials are constantly increasing drastically in price? And I'm just scrambling day by day trying to figure out, well, the stuff that I bought yesterday or maybe, a couple months ago, that stuff costs less, but if I sell it at that price, I'm not going to have enough money to buy more raw materials to make more. So I got to raise the price of the stuff I'm selling just so I get enough money to buy more raw materials so I can make more product. But I'm not even sure what to charge because the prices are changing so fast. So that would be the problem. And it would be very disruptive if inflation was really high and particularly unexpected. So generally, the Federal Reserve is going to look for low, stable, consistent inflation. And they're going to like that because people can plan for it. They can expect it. Not as much of a problem. Now, you might be thinking, what about deflation? Deflation would mean that price levels go down, right? Well, what's wrong with that? I mean, everything gets more affordable. Well, let's think about that. So if you actually had significant deflation, where basically prices are going down, what that kind of means is that there is less money chasing goods. And what that means is people aren't buying as much stuff. And if people aren't buying as much stuff, businesses aren't making much money. If they aren't making much money, then they're going to start laying people off. If they're laying people off, they lose jobs. And you know what you don't do when you lost your job? Buy things for the most part. You tend to cut back. And so if you're cutting back when you lose your job, then you don't buy stuff. Then businesses don't sell stuff. When they don't sell stuff, then they don't make much money. If they don't make much money, then they are struggling. And if they're struggling, then they start firing people and laying them off. And then those people don't buy much stuff. And it kind of can turn into this nasty, nasty spiral and get into what's called a deflationary spiral, where it just spirals into more and more and more people being laid off and out of work and businesses collapsing and failing and things like that. And it just can get into a really bad situation. So generally speaking, the Federal Reserve is not going to like deflation because it can turn into that whole scenario, which can be very destructive. Also, if you think about deflation, if price levels were dropping, one of the things that could drop would be your wages. Now, if you think, all right, so let's say the price level drops in half, so now eggs and milk and bread, everything costs half as much. Okay, so if they drop my wages in half, big deal. I can still buy the same amount of milk, eggs, and bread. Cool, no problem, right? Here's a small problem. You know what didn't drop by half? Your mortgage. Your mortgage didn't drop by half, or your student loans didn't drop by half. So you borrowed that money previously, and just because the price level dropped didn't mean that your debt dropped. So now you're getting paid half as much as you were in my example, but your debt level and your debt payment is exactly the same, which means you're going to have a terrible time making your payments. Or if you're a company, your bond amount is still out there, the same dollar amount, but now you're making a whole lot less revenue than you used to. You're going to have a much harder time actually making the payments on that, which means people are more, and companies are more likely to go bankrupt. So deflation, not something that we tend to like. So if you're looking at the Federal Reserve, they don't like deflation because it can turn into that whole mess. People basically aren't able to pay their debts, and you get a whole bunch of layoffs and things like that. So generally, what the Federal Reserve is going to target is nice, slow, stable, predictable inflation is what they're going to target. And generally what they've specified is, at least the past number of years, probably right around 2% inflation is kind of what they'd like. They have that. It's relatively stable, relatively predictable. They're going to think this is good, right? People can plan for it. It's not too bad. We don't get into that deflationary spiral mess. Kind of like it. So when they talk stable prices, it doesn't mean that there's no price change. We're talking that generally for the economy as a whole, not just individual items. We're looking for reasonably stable, predictable inflation measures. And often the target in the US has been around 2%. Okay, so nice, stable, predictable. That's kind of what they're going for. But they're also trying to have rapid economic growth too. So they want growth. We want balance of payments equilibrium. So we want to have nice, we don't want to have huge trade deficits, trade surpluses, or any of that stuff. So they're trying to achieve all this stuff. And sometimes the things might be pointing in opposite directions. So in order to achieve more employment, for instance, we might need to lower rates. Okay. But if we lower rates, that means that we're putting more money into the economy, which tends to promote basically more money chasing the goods, which is inflation, which would mean we don't have stable prices. So sometimes you can have things pointing in opposite directions. So if you're the Federal Reserve, what do? Well, generally speaking, they're going to tend to focus more on inflation as kind of the primary target. At least they have over the past few decades. Now, if you go back to like the 1970s, I'd argue that during the 1970s, when they had the stagflation period, what that meant was basically the economy was kind of stagnant, so not a lot of great growth, and they had inflation. So that was just kind of ugly. The economy wasn't growing well, but we still had a whole bunch of money chasing goods. We had a lot of price levels were rising. This was kind of bad. And one of the things that kind of went on during that period is the Federal Reserve would kind of raise rates a little bit to deal with inflation. Because if inflation is too much money chasing too few goods, if you raise rates, basically you disincentivize people from spending. You basically tell people don't spend, don't borrow and spend. It's too expensive. Don't borrow and spend. And so it makes people spend less since we have less money chasing goods. So when the Federal Reserve is worried about inflation, they raise rates, basically to try to pull money out of the system. And I'll do a little bit more explanation for that in a subsequent video. So basically what they would do is in the 70s, they raised rates a little bit to try to deal with inflation, but by raising the rates, it made it harder for businesses to make money. People didn't want to borrow and spend. So as a result, unemployment started to creep upward. Well, then they lower rates to try to help stimulate economic activity and therefore helped unemployment. But when they did that, inflation came back. And so basically what happened was in the 70s, they wound up with that stagflation period where the economy didn't grow real well. Inflation was not where it needed to be. So they had kind of a little bit more of a stagnant economy and the inflation, and it just wasn't great. And then towards the end of the 70s, early 80s, basically the Federal Reserve said, this isn't working. And so essentially what they did is like, we're just going to focus on the inflation issue. We're going to solve that and kind of see where that gets us. So they basically focused on inflation. And so they raised interest rates sky high. Okay. So think short-term rates were deep into double digits. Okay. So, I think it was like 15, 16% at certain periods there. Okay. Short-term interest rates. Imagine that. Imagine a 15 or 16%, short-term rate or 14%. You're way up there. I mean, just imagine that for a short-term rate. Well, basically what that did is that put a screeching halt to the inflation because when interest rates are that high, money is not going to be chasing goods much because people are just not going to be spending much because they can't borrow and spend at that point. So that basically brought a screeching halt to the inflation. It also kind of touched off a bit of a recession and wasn't great for unemployment. But what it did do is it basically stamped out the inflation, and it also communicated to people that, hey, guess what? The Federal Reserve is actually serious about this, and they don't want to let this basically continue. And that actually kind of created an interesting situation. So here's kind of a little important side note as it relates to this. Inflation is sort of a self-fulfilling prophecy. And here's what I mean by that. If you thought inflation was going to be extremely high in the next month, what would you do? Well, kind of makes sense to go buy stuff today before all the prices hit and rise, right? Well, if you do that, well, and everybody else is thinking the same thing makes sense. Well, if everybody goes out there and tries to buy stuff today, well, we're going to have a bunch of money chasing goods. We're going to get inflation today, right? So basically, if everybody believes inflation is going to occur, their rational response is to go spend the money now before the inflation happens, and that can make inflation happen. So basically, if people believe it's going to happen, it can actually create it. That's what I meant by a self-fulfilling prophecy. So here's the problem with that. If people don't think the Federal Reserve is going to deal with inflation, then they start to behave in a manner that is expecting inflation, and that can actually create inflation. And now the Federal Reserve has to deal with it. So if people, on the other hand, believe the Federal Reserve will not let inflation get out of hand, then they're less likely to go out there and panic buy in anticipation of inflation. And as a result, we're less likely to get inflation. So back to the early 80s. late 70s, early 80s, the Federal Reserve shot interest rates sky high. And if you look at a short-term interest rate, like a federal funds rate graph that includes that period of time, or pretty much 10-year Treasury bond graph, pretty much any kind of interest rate graph that includes that period of time in the United States, what you're going to see is this huge spike of interest rates during late 70s, early 80s kind of period. And basically, one of the side effects of that was people looked at that and they thought, wow, the Fed is serious about being focused on inflation. They are trying to get this under control. They are not going to let inflation get out of hand. I mean, they are willing to just raise interest rates sky high to deal with inflation. And as a result, people kind of figured, well, they're not going to let this get out of hand. And if you don't think that the Federal Reserve is going to let it get out of hand, then you tend to not go out there and buy stuff in anticipation of inflation, and you tend to get less inflation, and it winds up actually being easier for the Federal Reserve to deal with inflation. So if you're the Federal Reserve, what's really not good is if people stop believing you're going to do your job. If people stop believing the Federal Reserve is going to stay on top of it, then it actually starts getting a lot harder for the Federal Reserve to actually address the situation, and they have to start getting more drastic. Now, importantly, again, for inflation, we're talking prices are going up across goods and services as a whole, not just individual things. Now, for the Federal Reserve, they're going to look at all kinds of indicators to try to figure out what's happening with inflation, what's happening with the economy, what's happening with unemployment. They're trying to look at all these things to piece together what do we need to do with those interest rates? Because they are trying to achieve not just the stable prices, the inflation piece, but they're also trying to be mindful of unemployment and economic growth and things like that. So they're going to look at all kinds of indicators. And they're even going to be looking at those different indicators regionally, because different regions of the country can be more influenced by different industries and things like that, trying to figure out what policy makes sense for the country as a whole. And one of the things they're going to look at would be asset prices, including the stock market. And so they're going to be interested in what the stock market's doing and what investors are expressing through their choices in the stock market, trying to figure out what should we be doing. And if you're the Federal Reserve, I would argue you kind of have a somewhat thankless job, because no matter what you do, somebody's going to be unhappy with what you did. And importantly, if you're the Federal Reserve, one of the challenges you have is that you're kind of constantly making choices based on the best data you've got, but by the time you've got that data, it's already kind of old, right? So if I think about the economic data, if I look at the economic growth for the most recent quarter, well, by the time I've compiled all the data and put it all together and looked at the data so I know what the economic growth was for the last quarter, well, some time has already elapsed and I'm already in another quarter, right? And so by the time I'm looking at some of these factors, like it's already old. So it's kind of like trying to drive a car while you've put a sunscreen in the windshield and you're trying to drive forward, but by looking out the rearview mirror. And so you're trying to see whether you're straight on the road by looking out the rearview mirror. And that's kind of what the Federal Reserve is stuck doing, just by the nature of the situation. They're going to try to use the most timely data they've got, but they don't know the future, and there's going to be a lag. And so it's a little bit of a challenge. Anyway, hopefully this kind of communicates, kind of what the Federal Reserve is doing and why they do what they do and kind of how they function a little bit. It is worth noting that there are some differences of opinion on whether there should even be a Federal Reserve and things like that. That's a whole nother story. The focus of this video is just kind of on how it operates, what it's looking at, what some of its mandates are, and kind of how that's behaved a little bit historically. All right, thank you so much for watching, and have a great day.